Moderna's stock recently ripped upward, surging as much as 125% intraday. The catalyst was a joint announcement from Moderna and Merck. They successfully completed a phase 3 trial for an experimental mRNA cancer vaccine, intismeran autogene, used in combination with Keytruda. These trial results provide the first clinical evidence that Moderna's mRNA technology can effectively target tumors. The data moves the company's valuation anchor away from COVID-19 vaccines and directly into the oncology market. This leaves investors facing a multi-billion-dollar question. Is this new $170+ price range the permanent floor for a future trillion-dollar company, or are we looking at a temporary momentum bubble? To answer that, we have to look at this dual-axis chart showing market mechanics. The line shows Moderna's vertical price spike, but the red bars underneath show that a massive 14% of the stock was held by short sellers right before the clinical data dropped. The clinical breakthrough is entirely real, but the immediate stock surge you're seeing is a dangerous mix of fundamental value and forced institutional panic buying. When a heavily shorted stock suddenly gets explosive positive news, it triggers a short squeeze. Institutional short sellers are forced to buy back shares at any price available just to cover their positions and stop their losses. In this specific squeeze, short sellers faced billions in paper losses in a single trading session. They bought blindly to exit. Historically, these mechanical overshoots almost always correct themselves. Once the forced buying dries up, stocks typically see a 20 to 40% technical pullback in the following weeks. We also have to weigh the current market reaction against the commercial timeline. An FDA submission takes time, and this specific cancer drug is still years away from generating actual revenue on a balance sheet. Buying into Moderna today means you are paying a massive squeeze premium for a clinical milestone. It ignores the grueling commercial reality that still lies ahead. If we move to the factory floor, the first commercial hurdle becomes obvious. mRNA 4157 is not a standard, mass-produced seasonal vaccine. It is a highly complex, personalized therapy. Every single patient requires custom genome sequencing. That biological data is then used to synthesize a bespoke treatment, a process that takes 4 to 6 weeks per person. This creates a severe cost of goods sold bottleneck. Current industry estimates place the manufacturing cost of this personalized dose at a staggering $30,000. Unless Moderna can scale operations and cut that manufacturing cost in half, their profit margins will remain dangerously thin upon release. Those high base costs are going to collide directly with Medicare reimbursement negotiations. CMS will aggressively pressure the final price tag to maintain healthcare affordability, leaving Moderna caught in the middle. While the drug scores a perfect 10 out of 10 on clinical efficacy, its current commercial viability scores poorly. That leaves the company's profitability timeline highly vulnerable. The second major hurdle is regulatory. The current data proves relapse-free survival, which is excellent. However, the FDA's gold standard for oncology is often overall survival data, which takes far longer to mature. If the FDA demands complete overall survival data before granting full approval, Moderna's timeline gets entirely rewritten. Commercialization could easily be pushed out past 2027. Moderna's stated corporate goal is to reach cash flow break-even by 2028. A commercial delay to 2027 burns through their $6.9 billion cash reserve and directly threatens that timeline. Beyond the FDA, there is a macroeconomic tail risk. High-profile political figures, including Robert F. Kennedy Jr., have publicly stated intentions to cancel hundreds of millions in federal grants used to develop mRNA vaccines. Federal funding disputes create a layer of political risk that can depress the stock price, regardless of how well the laboratory trials are performing. Right now, the market is pricing in a flawless, friction-free product launch. In a heavily regulated, politically charged biotech sector, a flawless launch is a statistical impossibility. To separate the hype from reality, take a look at this vertical chart. We are using a sum-of-the-parts valuation to calculate Moderna's fair intrinsic value. The dotted line at the top is the current $174 trading price, and the lower line is our baseline target. Let's fill it in. First, if we divide their massive cash reserves by total shares, we get $12.40 per share. Next, applying a standard multiple to their existing respiratory vaccines gives us another $29.50 per share. Now we add the net present value of the mRNA cancer platform itself, calculated based on its expected earnings over a 15-year outlook. That adds $100.60, bringing our total fair value to exactly $142.50 a share. That $142.50 calculation represents an incredibly successful company. But the gap between that fair value and the current $174 price tag is pure short squeeze premium. When we weigh the probability of clinical success against the current price, the model predicts an implied annual return of -5% over the next 3 years. Buying today means paying for a perfection that isn't guaranteed by the current math. This decision tree flowchart gives you 3 distinct paths. If you are a current shareholder, this mechanical surge is a gift. You should strongly consider locking in at least 50% profits in the 170 to 185 range to de-risk your portfolio. If you are a momentum buyer feeling FOMO, pass on the stock today. Do not step in right now, or you will simply become the exit liquidity for institutional short sellers closing their positions. For strategic value investors, the long-term cancer thesis is intact and incredible, but patience is required. Wait for the inevitable technical pullback to an action price of $120 or lower. Buying under $120 secures a mathematical margin of safety beneath the company's true intrinsic value, protecting you from manufacturing delays and regulatory friction. Do not let a historic medical milestone trick you into making a disastrous financial entry. Wait for the market fiction to collapse and buy the clinical reality on a discount.